Hi, this is Mr. Evans. This video is on overtrading. So it's the final video. No, it's not, because we've got to do Grinder's model of growth next. But we're continuing with this look at some of the issues, problems that growth and retrenchment can create. So what is overtrading? Well, we did look at it in the finance unit in AS 3.5. Overtrading occurs when an organisation lacks the finances to fund their expansion. So essentially, overtrading is a cash flow problem that is caused by the rapid expansion of that business. Basically, they grow so quickly that they run out of cash. So why might that occur? Well, it might occur because there has been significant investment in new capacity, maybe building a new factory because they're trying to grow their output, or building new shops, and these aren't yet generating revenues. This can be particularly an issue if that spending on the new capacity was more expensive than budgeted. So if there's unforeseen problems maybe in the construction of new buildings, or the kitting out of new buildings, or the installation of new machinery in a factory, we've budgeted a certain amount of money and we're expecting the revenues to start coming in. Well, maybe if we have been maybe a little bit generous in terms of how long we thought we could, we thought we'd basically start generating cash sooner than we have. So we might run out of money as a result of that, and that would be an example of overtrading. If trade credit is going to be required in order to utilise the increased capacity, so in other words, we might build a lovely new shop, and it's all decorated nicely and so on and so forth, but in order to get stock to sell from our new premises, maybe we need trade credit in order to do that, and that's going to affect our liquidity, the money we've got available for our day-to-day finances. Maybe the business is going to accept maybe it's just simply that the business is growing and they accept a contract that's going to require a lot of money invested before revenues are generated, and again the business might think, well, okay, we're going to need this much money, and then on June the 4th we're going to get paid. But what happens if money runs out before then? And you should remember from Unit 5, the finance unit, that many businesses get into financial difficulties as a result of cash flow problems. It's not necessarily that the business isn't profitable, but in this case, through rapid growth, overtrading, we run out of finance. It could be as simple as the customers don't pay as quickly as we anticipated. We offer credit and customers don't pay. So essentially, how do we deal with this problem of overtrading? Well, let's imagine that this factory is overtrading. There's two ways of dealing with it, just like we would deal with cash flow problems. First way of dealing with it, we get more money in. So how could we do that? We might sell off buffer stock. If we've got unused stock on the premises, we could get rid of that. We could sell any unused assets. So if we've been a little bit over generous in how much, new factories we thought we might need, or maybe we've bought shop premises we're not going to be able to use, maybe we sell that on, cut our losses, get some cash in, and continue trading. Maybe we need to chase up our debtors. We've got customers that aren't paying us. They've said they would and they've not paid us yet. Maybe we need to chase them up. Maybe we've been so keen to attract new customers and expand, we've been offering really generous trade credit. Maybe it's time to rein that in a little bit and just think, well, important for the long-term survival of the business is actually getting cash in. Finally, we could take out a bank loan. Okay, in this situation, we would be improving our liquidity at the expense of the gearing of the company. So we borrow money with the intention of paying it off in 3 to 5 years' time when the company has expanded and is getting in those revenues. And that allows us to survive in the short term. So we improve our liquidity position. We get cash into the business through the loan, and we defer the payment of that loan till later on, affecting our gearing. On the other hand, we could cut the money that's leaving the business. So all of these green arrows represent money going out. These red arrows are going to represent money leaving the business. So we could simply try and reduce our expenditure. Do we really need to build this new capacity, that new factory? Can we cut costs elsewhere and basically just improve our liquidity position so we've got more money in the business? Can we negotiate trade credit with our suppliers? So if we do need to kit out a new shop with stock, can we get some trade credit for a month or so that we're able to generate some revenues and hopefully pay that off in a month's time? Or can we, do we need to invest in the new fixed assets ourselves? Can we lease fixed assets instead, maybe rather than buying them outright and pay a monthly fee rather than a big upfront fee? Maybe we could even outsource some production in order to cope with increases in demand. So all ways there that we could either increase the money coming in and reduce the money going out. Essentially, overtrading is cash flow issues that are caused by a rapid expansion of the business.